to calculate the retrospective rate, CAGR, and other rates return. Hello scholars, we have discussed about cost of the mutual funds. We have discussed about risk parameters. Today we are going to discuss very important aspect of investing, that is return. This return concept is fundamental, and if you are investing in any investment product, whether it is gold, mutual fund, shares, or even FD, you must know about return. So what exactly return means? Investment, return means extra amount. Suppose if you invest 100 rupees, how much extra you get? Suppose you got 120. So you got 20 rupees extra. This is return. Okay. Return means extra amount you get above your investing amount. That can be considered as a interest. When you do FD, you get the interest. That is also a return. When you buy gold and sell at profit, return is also considered as a gain or profit, or just change in the price. That means difference between two, starting price and ending price. So these are the different words. They are more or less same. Extra amount you get, interest is also return. Change in the price is also return. Gain, profit, and even loss is also negative return. Okay, so let's understand by simple example. Suppose there are two friends, Amit and Viru. Amit invested 100 rupees in the gold. Let's imagine in the gold. Viru invested 200 rupees. When gold price was at 200 rupees, he bought a gold, and when Amit bought at 200 rupees. Amit invested for 5 years. Viru invested for just 1 year. An amount when he sold, he got 150. Viru 250. So as I discussed, gain is also return. So first thing is to take the difference. How much is the difference between starting and ending price? So it is 50 rupees difference, So take the difference. That is 150 minus 100. 150 minus 100 is the gain, return, profit, extra amount. Here also 50 rupees. Now you see that both got the same gain. But is it comparable? Answer is no, because their principle is different and time also different. So to make comparison appropriately, we have to standardize. First step in standardization is take the percentage of return. How do we do that? We divide whatever the amount we get with the principal amount. That means 50 rupees divided by 100 rupees. And we get the return, that is 150% now. Similarly here, 50 rupees gain divided by 200 rupees, percentage gain is 25%. Is it comparable? No, still it is not comparable because time is different. So here, just for thumb rule or understanding what I can do, I can divide this return by number of years. Okay, for example, 50% gain in 5 years, 50% gain in 5 years. So we can say 10% per year. Here, 25% gain in 1 year, 25% per annual return. So this is annualized. Now here I use simple annual growth rate. It means whatever the return I got, I just divide it by number of years to get the simple annual growth rate. This can help you to calculate quickly. Okay, we can consider as a Sagar. Sagar, simple annual growth rate. But this is not used in the banking and investment frequently. Okay, this can help you to do quick calculation. For example, if someone says he got a 70% return in 5 years, okay, so we can divide 70% return total by 4, 5, and 14. This is not a CAGR, that is not compound annual growth rate, but simple Sagar. So remember Sagar and Kyagar. Kyagar is the most commonly used, but I explained Sagar just to create some base. Okay. Now, how compounding happens and compound annual growth rate is calculated. Okay. For example, if you deposit 100 rupees in a bank, next year you get 107 rupees, 7 rupees interest. Okay. At the 7%, if you say. So what happens then? The next year, this 7 rupees is reinvested, and this will be considered as now new principal. Okay. And you will get addition 0.07. Okay. This will be the interest now, second year. So what will happen third year? This will get added to your original principal. Now third year principal become 114. So interest will be calculated on the new principal. So this amount is reinvested, new principal. So here you can see how much interest you will get in third year. You can multiply by 0.07. So third year interest is 8. And now if you add this again, it is called as reinvested. Now you can see here, I'll add one more here. How much will be the interest in this year? Although rate of interest is same, but you can see that in every year interest amount is increasing because the interest is reinvested again here. This 7 is reinvested, and then fresh interest is calculated on the new principal. Similarly, this is again reinvested. So principal is also increasing every year, and interest amount is also increasing every year. This is called as compounding. And that's how, let's say this is the amount and time. This is how amount increases rapidly. It is called as compounding. This is an important concept. This is 7th grade subject. It has been taken that time as well. You can revise as well. Okay. So there are now 4 parameters, and this equation, I call this as a E is equal to mc square. The way E is equal to mc square in the physics, this is a master equation of finance. It is investing banking. Entire investment banking is depend upon this single equation. So you should be very much expert in this equation. So what is it? This is amount when you get at the end of period. This is a starting amount, that principal multiply by 1 bracket return percentage, rate of return, and raised to n. This n is here. Okay. So this is power raised to n. N is number of years. We call this as apron. The way we have apron for the doctors to remember apron. This apron equation is extremely important in finance and banking. Now, if any 3 values are given, we can calculate 4th value. For example, let's say if you invest into the bank 1,000 rupees and 7% interest rate, and for 5 years, then you can calculate amount by using this equation easily, because these are already available. How do you calculate? Suppose you can calculate, first you can calculate the bracket. Okay, I'll write 1,000 multiply by. So you can calculate this on Excel directly, or Chat GPT or Google, but just this is basic understanding, sure, so you understand it. So 1 plus return percentage is 7%, and power raised to, it will be 5 here. Yeah, right here, 5. If you solve this, how can you solve? So let's take bracket. Here it will be 1.07 when you solve this, and then 5. So let's solve now entirely. 1,000 multiply by 1.07 raised to power 5. You get the answer. So that means this is the amount you get. You can put direct value as well, but I just shown a simplified version. But this is a simple mathematical calculation where 3 are given and you put and get the value. Okay. So similarly, if amount is given, rate is given, and number of years given, we can calculate the principal as well. Okay, this will help you to calculate how much you want to invest as of now to get certain amount in future. Okay, so this equation you can use to find out the present principal from the future amount you want to get. Okay, similarly you can find the rate as well. The rate is calculated like this. Rate means how much, if three are given, a is given, p is given, and number of years is given, then this is the formula to calculate the rate. And this is used in almost all investing where we do not know the rate before investing. For example, gold, shares, real estate as well. Okay, this formula used to calculate the retrospective rate, CAGR, and other rates returns. Similarly, we can calculate number of years from if AP and rate are given. This is a little complicated. Don't go into that detail, but possible. Okay, this is very simple. That means these are only four numbers. Are they are just rotating around. Okay. Now we want to understand the returns in mutual funds. Okay, and how do we guess whether mutual fund is performing good or bad or not performing? We have to compare it. Okay, how do you compare? We can compare with the FD return. We can compare with the benchmark or index or passive funds or peer, that is category and other mutual funds. Okay. This is the comparison based performance. Okay. What are the types of return we do use for comparison? One is point to point. That means you know the starting value and ending value, 2 points. Okay. We use SIP return, we use a trailing return, we use a rolling return. Okay. These are the just shortlisted. If you want to see different types of return, then there is a number of different types of returns. Easy to remember. First, single entry, single exit. That means if you buy gold in 2010 and sell in 2025, so single entry, single exit. It is applicable in the real estate, gold, or even shares as well. Single entry, single exit. You have what you have information about A, P, and number of years, and you can calculate retrospectively the return. So please understand, whenever we calculating CAGR, it is retrospective. Okay, in a gold equity, you do not know how much return you are going to get. Okay, at the time of investing, you only know in the debt product how much return you are going to get. So in a gold equity, that means share market related products, the rate of return is always retrospective. Okay, that means you know the amount at the end, you know the principal and how many years you are holding the investment, and from this you calculate the return. Okay, so if there is single entry, single exit, it is called as CAGR, compound annual growth rate. Point to point is a type of CAGR. And then there is another variant, trailing return. So these are single entry, single exit. Write it down. Can there be single entry, multiple exit? Yes. If you buy any annuity plan of pension fund, you invest in amount single entry, that is single premium, and you get a pension for next 20, 30 years. That is time pension is calculated, and it is called as annuity. So these are the names of returns: annuity return, point to point return, trailing return, CAGR return, SIP return. Okay. Can there be multiple entry and single exit? Yes. When you do the SIP, you entering at multiple points and you are exiting at single point. It is called as SIP return or XIRR. X extended internal rate of return. So this is also return. These are all returns. Can there be multiple entries and multiple exit? Yes, when you do the SIP, SWP, that is also possible. But as of now, this is not required for you. You are at the wealth creation zone. So this R is XIR we're going to discuss, and this four we are going to discuss. Rolling return is another type of return that we are going to discuss. So this was theoretical background. Now let's go to the practical. Suppose you want to invest in an equity fund for the growth. Okay, there are three reasons for investing in mutual funds: protection, parking, and growth. For growth, you have to invest into the equity. Okay, let's go and try to find out equity funds. Okay, so these are the categories: equity, debt, hybrid. In equity, you go click here, and there are multiple subcategories. Okay, so let's say you want to find out all equity categories excluding sector fund. Sector funds are the special fund which invest into particular sectors. So let's understand the except this. We want to check all other. Okay, and apply. Okay, now focus on return only. There are 642 mutual funds. Okay, how do you start applying your knowledge? First step is to go and click here, understand point to point return. So here you can type January 2019. You may say why? Because it is before COVID. So we want to understand. No, this is the starting date, January 2019. And here you can apply January 2025. So you can see 6 years. So you are taking the data of 2 points, 2 dates. You are deciding yourself. You are deciding both dates. So write down when you decide both dates to calculate the return, it is point to point. Okay, so this is the point to point return. And if you click here, you'll see that lowest return is 11%, highest return is 32%. Okay, there are we can download Excel file as well, but just see that point to point return. And this point to point return is CAGR. Okay, CAGR, 6 year CAGR. Can say 6 years data and CAGR. From here, you can find which are the out of 269 stocks, 269 mutual funds, how many are top performing. Now you initially saw you more than 600. Now why it is reduced? Because when we select point to point, the recent mutual funds are automatically filtered from here. That means there are 269 funds which are more than 6 year old. You can export this. Okay. So if you don't know Excel, I don't think that is required as well, but you can sort on that website itself. So this is point to point return. And if you want to remove the, you can use Excel and remove the bottom half for the filtering process. But as of now, we'll discuss that later on, how to select. But this is how point to point return is seen on the value research. Calculate point to point. Okay. When to use? So when you are doing the screening of the mutual funds, start using first point to point to get the idea which are the top funds in the entire mutual fund category. Then go click on the return here. Next is XIP return. So here, oh, before that, what we'll show after point to point, I'll show the trailing return. So write down point to point return is CAGR. There is another CAGR type. It's trailing return. If you click on long term, you see the 5 years here. Here 35. So what is the difference between point to point and trailing? This is also CAGR, but in point to point, you selected 2 dates, starting date and ending date. In trailing return, you select ending date. Ending date is today's date, and automatically machine will take previous 5 years. So trailing return, this is the trailing return. Trailing return is also CAGR, but here you select the today's date and automatically 5 years data will be selected by a machine software. So this is 5 year CAGR return from today backward. Okay, you can sort data and find out which is giving more return. You can see this. Okay, top performing in 3 years, 5 year. We usually select 5 year, 3 year. So two types of CAGR. One is point to point, other is trailing return. The difference is that in point to point, you select 2 points, those can be fixed. And in trailing return, every day data will change because it will be taken automatically. So when you do the mutual fund assessment per every year, once in a year, you can start with the point to point, and you can fix January to January data. So that it means if all of you, all 100 people select this data based on the point to point, everyone will get the same list, because it will not data will not change from 1st January to 1st January to 19 to 25. Data remains the same. Trailing data remains trailing data changes every day because date changes. Okay. Third type of return we are looking for is the SIP return. Okay, here. Okay. Now here SIP return is multiple entry. Okay. Multiple entry. Every month you are investing. Let's say if you started SIP 5 years ago in this mutual fund, and how much will be your value today? So this will be your XIRR. This is XIRR. SIP return is XIRR. What is the difference between CAGR and XIRR? CAGR has only two values, starting, ending, and XIRR has multiple entry, multiple exit. Detail theory is very complicated. I don't think you should go into that detail. But for SIP, XIRR is useful for comparison purpose. From here, you can compare which is better amongst the category. Okay. So I discuss three types of return as of now. Point to point in the long term, where 3, 5, etc., and SIP. There are others as well, but don't go into too much details as of now. For long-term investor, these 2, 3 are more than enough. Okay. Now I'm going to show a rolling return. Now rolling return, value research, they take the paid version, but free version is available on the another website is this. Okay. So what is rolling return? Suppose Parag Parikh. Okay. Okay. This is the mutual fund, Parag Parikh. Okay. And you can start from the 2015 data. Okay. In-app data. And first, select 5 year rolling return. Okay. I'll explain what is it. I'll remove the index, or start from the 1 year. Okay. 1 year rolling return. And what does the chart represent? Now, this is 1 year data. So if you see the arrow here, see the data. There is as of now, my mouse shows it is 1 year return between May 2020 to 21. Return is 71%. Okay. That means if someone invested in on the 19th May 2020, next 1 year he would have got 71% return. Okay. But what about next 2 days, next month? If his friend invested in next month, his return would be 61%. Why this return changes? Because prices changes. So this rolling return, okay, here the data is collected every day. Okay, see this. And first data is collected, every day return is calculated. Now we selected 1 year period. So this is 1 year data is already plotted first. So this is the entire data of 1 year, 1 year, 1 year, like this. Okay. And but this is not rolling return. Rolling return is down here. The statistics is the rolling return. So there are so many data points. Those data points, the statistical analysis is done, and how much is the average of all those return? How much is the median? How much is the maximum? And how much is the minimum? Okay, this is a rolling return data statistics. Okay, many people misunderstand that this is a rolling return. No, this rolling return is this data. Okay, this is the graphical representative of 1 year return taken every day. Okay, so in short, this is a trailing return, 1 year return plotted. Suppose if I select, you note down first these values. Average is 21, minimum is 18, and maximum 100%. What does that mean? So this will be the minimum. Someone got minimum return, someone got the maximum return. Okay. So this is data where minimum return, maximum return is there. Now select the, I will show the magic, how when you hold for longer period, how your risk is reduced. This was my thesis topic of MBA finance, where uh, you can see yourself. Now, maximum was 100 and minimum was 19. Now the range is reduced. When you select 2-year rolling return, range is reduced. Now each data point represent 2 year CAGR. Okay, 2 year CAGR. If I select 5 years, see the minimum and maximum range is reduced. Now minimum is 24, maximum is 33. Okay, that means no one has got negative return. If you select 10 years, okay, 10-year data is not available here because it's a direct plan. Let's select 7 years. So now minimum and range is very narrow, just 6%. Previously, you saw that it was 100% and minus 18%, minimum and maximum. It was wide range when it is 1 year. But if you hold for 7 years, the range of minimum and maximum is very less. What does it mean? Your risk of negative return or drawdown is reduced when you hold for longer period. Okay. Same way you can see the data distribution here as well. That means here you can say less than 0% return, 0 to 8%, 8 to 12%, 12 to 14%, 12 to 40, 15, 15 to 20, and greater than 20. Suppose if people invest in this fund and hold it for 7 years, everyone, everyone got more than 15% return. Okay, see this. 55% people got more than 55%, more than 20%, and remaining got between 20 and 15 and 20. So no one got less than 15% if 7 years. What about 3 years? So this is a 3 year. No one get lost money. That means no one has zero, less than zero. But some people got 0 to 8% return. Between 8 to 12, there is 8% people. Here, 12 to 15, 15%. So as you go shorter duration, again range wides. So now here 9% people got negative return. That means less than their invested. So from rolling return, what interpretation you can do? First interpretation is this gives and proper comparison because it consider a lot of data. So if you want to have correct comparison, rolling data, rolling return is ideal. That is one aspect of rolling return. Second rolling return aspect is you can see the evidence. This is evidence-based investing, that if you hold for 7 years, you cannot lose the money in a stock market, especially in mutual funds like diversified mutual fund. This is the data. Okay. At the beginning, it may sound little complicated, but this is a once in a lifetime learning. So I don't think you should get too much worried about that. So let's put here, read about point to point return, trailing return, SIP return. Rolling return is the decision maker. That means when if you select mutual funds and there are 2, 3 mutual funds, then you want to make the comparison, then it will be useful. For screening purpose, these are enough. Okay. This SIP return is XIRR. So read about XIRR a little further because if I start explaining, it will get complicated. As I mentioned, at the beginning it might sound complicated, but this is once in a lifetime learning. Once you learn, this knowledge will be with you forever, and this is must. It is only the matter of time. That means Whether you want to learn now, after 1 year, 3 year, 2 year, 6 year, 10 year, whenever you are investing, taking loan, you cannot excuse this. So read these four types of return. You don't have to read all types of 10, 20%, 20 types. At least these are the which required. Okay, so this here we completed the most of the parameters on the value research. Okay, these are necessary for the selecting active mutual funds. So now you search yourself and find it out. We have selected portfolio, risk, fees, other details, and do the comparison. Where is your mutual fund standing? Okay, so here you have to learn two things for mutual fund: to make a list, to enter, and you will learn by the end of the course. Okay, second, analysis of mutual funds which you already investing, existing. These are the two reasons you are learning. Okay, so here the approach is little different. Here approach is little different. Okay, in this case you have to do the analysis which I explained in last 5 6 video. You go to each mutual fund, find out all parameters, and to base select the best mutual fund, you have to start from the top down. So this is a top down approach, and this is bottom up approach. That means you start with the name of mutual fund and do the entire analysis of the mutual fund. Here you start with the category and zero down 2 3 mutual funds. We are going to discuss this as well. Okay, as of now I focused on this. Okay, what about the mutual funds? If you click directly on some, and there is another performance as well. What is that return? So this return is the trailing return. Let's say 1 year, 5 year, 3 year, 2 year. Okay, so here it is not showing. Let me show the another one. So if you click on the return, there are discrete return as well, annual return for comparison. Okay, these are the calendar year return, fixed period. It will not change, but trailing return changes every day. Okay, this is 1 year trailing return. If you see the 3 year data, this return over time. So 1 year, 3 year, 5 year. So we use this three for to assess mutual fund performance. Okay, these are not required. Too much is not required. Even this is not required. Why? Because this is too old data where SEBI categorization was not appropriate. So focus 531. Okay, and here is the comparison directly with the if this is a mutual funds, this is the index, and this is the category peer group, and you can see number of funds in this category and where is this fund located. Okay, so if 5 year there were 55, amongst 55, is it in top one third or at least top half? You can see definitely here it is there. So this is, we also see the rank in the category, rank within the category. Okay, to find out where this mutual fund is located. So if you are doing mutual funds of your own mutual funds, you will select, click on the return, find out the return and compare with the index, category, and where is in the category. If it is at the bottom, then it is not performing good. It has to be at the top of the category. Let's say if there are 55, it should be at least top half, top 50%, top half. It should not be bottom. Here, if it is 73 means first 35. Here it is 92 means first 48. Obviously, this is there. Okay. So this is how you do the analysis of individual mutual funds. I discuss all parameters here: portfolio, risk parameter, other, return is now done. Okay. So now we'll go to the next topic of passively managed fund in the next video. Okay. So what we'll do, we'll discuss the first actively managed fund, passively managed funds, the fundamentals, and then we discuss the strategies and logistics later on. That means how many mutual funds should be there, what type of should be there. That will come later on. So first step we started with the actively managed fund. We'll discuss passively managed fund. Then we'll discuss strategy. Strategy means how many mutual funds, when to buy, when to sell, etc. And we will discuss logistics as well. Logistics means how to buy. Okay, so we covered this first part. We'll start this in subsequent video. Okay, I hope you are doing assignment and assessment every day. Okay, thank you very much.